Welcome! Ready for simple, visual accounting? Hit subscribe and let's go!
Retained earnings is a part of equity. It can be positive or negative. In case retained earnings balance is positive, it represents profit accumulated by business, but not distributed to shareholders. In case retained earnings balance is negative, it represents loss accumulated by business, but not covered by shareholders.
Let's analyze what is the relation between income statement and balance sheet in respect of retained earnings account. At the end of the period, a company calculates its net profit by taking revenues minus expenses. That net profit doesn't just disappear. It moves straight to the balance sheet. On the balance sheet, net profit increases retained earnings, which is part of equity.
Here's a simple example of how profit flows from the income statement to the balance sheet. On the income statement, the company earned $175,000 in revenue and had $93,000 in expenses. That leaves a net profit of $82,000. Now look at the balance sheet. Retained earnings started at $15,000. When we add the new net profit of $82,000, retained earnings increased to $97,000. Accumulated net profit, which is not distributed as dividends, moves to equity on the balance sheet and increases retained earnings balance.
Let's check another example where company makes a loss instead of a profit. On the income statement, the business earned $55,000 in revenue, but expenses were $71,000. That results in a net loss of $16,000. This loss also flows to the balance sheet, but this time it reduces retained earnings. Retained earnings started at $21,000, and after subtracting the loss of $16,000, the new balance is $5,000. So just like profits increase retained earnings, losses decrease them. Retained earnings always reflect the total accumulated results of the company over time, both positive and negative. Thanks for watching. Subscribe for more simple, visual accounting.